Hello there, you're tuning into the Wild Bat Podcast. I'm your host, William Archibald, and this is episode 5. We are going to be discussing module 3, which is the business limit and association. If you haven't seen it already, you may want to check out module 1 or recap it, because in this module we will be talking about a lot of expanded definitions of the business limit. The first criteria is what the business limit is in regards to it is the lesser of the Canadian net active business income, Canadian taxable income, and the business limit. So if you don't know much about that, shoot back to module 1 and look into that. The business limit has to be allocated amongst any corporation that is associated. The broadest way to think about it is one person is allocated $500,000 to be allocated to the corporations that they are in control of. If they own multiple corporations, then they have to allocate this however they see fit. Using Schedule 3 of your T2 tax return, you will fill this out and you'll list every corporation that you are in control of, if you meet the definition, which we will cover, and then you will allocate a proportion of the $500,000 business limit, or whatever the business limit is, to the corporations. I guess the business limit will be $500,000. Every corporation may have a different active business income. Okay. Another concept to consider when thinking of the business limit is that if you are running a short year, this may be the reason because you want to align some of your tax years. The best alignment is to make it align to the calendar year so that your slips match up as well as your personal income matches up between your corporation and your other tax obligations. So if it's less than 51 weeks, you have to prorate the business limit. The formula is pretty simple. It is the days in the fiscal year that you're reporting, divided by the full days of the year, 365, times the allocation. In this example, we have a company that has a 6-monthly fiscal year, which is ending on December 31, 2021. And to keep it simple, we have assigned 100% of the small business deduction. We want to assign 100% of the small business deduction, and it has an active business income of $450,000. However, because it's only 6 monthly, we have to account for 184 days of that 6 months, divided by 365, and then times by the full business limit that we want to allocate, which would only qualify for $252,000 worth of business limit that we can apply. That means that the remainder would not qualify for the small business deduction, and a simple calculation results in that almost $48,000 small business deduction can be used to reduce taxable income. Another concept when it comes to the business limit is that it does grind away if your corporation could be defined as large. If the total taxable capital employed, being the total assets of the company in Canada, is greater than $10 million, this will reduce the business limit. It's done on a scale so if you have $10 million worth of assets, then it will be reduced slowly to nil as your taxable capital increases from $10 million to $15 million. Using this formula here, we can define what the grind will be. However, is simply put, under simple scenarios, it will be a reduction of 10 cents for every dollar over 10 million. So the key part of it really, is, especially when you own multiple companies, is association. If one person has multiple corporations, they don't get multiple business limits. The business limit has to be allocated so that they don't get duplications of the small business deduction. What a lot of individuals try and attempt to do is they set up multiple companies in order to perhaps try and configure a concept where these companies are not associated. However, if you own multiple companies and you either directly or indirectly by any manner, note that this phrase, directly or indirectly, when it comes to control, is going to pop up quite often. By any manner. So we're thinking directly with voting rights and indirectly through influence. We're thinking about contracts, agreements that may have been in place. Obviously also expanding to if you have the right to retain more voting rights or reduce voting rights. Another concept of association you have to consider is if two corporations can be considered related if one corporation is owned by yourself and your wife owns another wife or husband owns another corporation, and then one of you owns 30% of the other company, then that could also be determined association of those two corporations, which we'll cover very soon in a diagram, or association by a third corporation, which we'll also cover in a diagram. I'm going to shoot over to the scanner now to detail this. All right, looking at the scanner here, we're going to first look at just the Income Tax Act. This is an old book that I bought at a garage sale. This section here of the Income Tax Act does cover section 126, more of the associated corporations. It goes into more situations of what are specified classes, because here it talks about, if the corporations are controlled by and the person is related and either person owns not less than 25% of the issued shares of any class other than specified class. The specified class here means simply not voting. So if it's a not voting class, it doesn't matter. We may look at that in another scenario. But first, we're going to look at our some association concepts. All right, so we have Mr. J. Circle means person, and a square means corporation. That's going to be the rule for all these diagrams. Mr. J owns Mr. J Corp, and Mrs. J owns Mrs. J Professional Corp. Mr. J owns 75%, we'll say, of his own corporation. And Mrs. J owns 100% of her own professional corporation. If Mrs. J here owned 25% of a non-specified class of shares here, because these individuals here are husband and wife, are related people, related parties, then these two are determined associated. If this didn't exist and Mr. J owned 100%, then they would both each enjoy the small business deduction allowance of $500,000 each. I've looked at another scenario, a real world scenario, which we're going to cover later on. There was the father, the daughter, and the girlfriend who all owned a 100% of their own companies. There was no other types of shares or nothing like that. So each of them did enjoy the full business limit. There was no allocating of any kind, so they all got the full business deduction. However, this is just the one factor. There's other factors that you need to consider. Another scenario, when we're thinking about a third corporation, we'll just do Mr. J and Mrs. J again. So this time they're going to set it up right. Well, we'll see. Mr. J Corp and Mrs. JPC, each owning 100% each. They learned their lesson, they took the advice, but then they started another corporation in which they own 25% or more each of the third corporation. Now, because there is 25% more, is over greater than 25% of each corporation, they are determined to have a group like around here and around here, which means that all of this as a group under section 256 part 2, if this corporation here applies for a special election, under the selection it gets a nil business limit. So regardless of how much income it has, it cannot be allocated any of the business limit. Then these corporations here can have that full $500,000 if this is defined as nil. We're going to cover that next. So notwithstanding the result of section 256 part 2, if that third corporation wasn't there and if that association didn't occur, then they wouldn't be associated, which it kind of states here in the not only on schedule, not only in the Income Tax Act, but also here, but would be for this section 256 would not be associated, but because of this section they are. However, you can apply for an exemption across it to avoid association. So very simple, you name the third corporation here and you name the other corporations that want the small business limit here. You still have to worry about the business limit grind. If it is defined as a large corporation, the third corporation will still have to, the taxable capital will still have to be included in that calculation. And there's a broad anti-avoidance provision which pretty much states if the minister deems it wants to make it associated, it becomes associated, one of the many powers of government. Right, looking back at control, so we, again, directly or indirectly by whatever manner whatsoever, again, we're looking at influence, if there are agreements in place, if there are certain reasons that can determine that one individual controls the corporation over another. The aim, remembering back to that prior scenario where there was, the father, the daughter, and the girlfriend who each own their own company. Further details into that, which I'll disclose, that the main company was run by the father. The other two companies were set up not necessarily get a small business deduction, but although they did, and it held no real other purpose besides, distributing further funds and activities away from the main company. It had certain purposes, but one could argue that it was all really done under one company. It was still one manager. The person controlling the operations was the father, and no one really knows I don't really know what else, other factors and other reasons there were of why the companies were set up. However, if we are looking at just a small business deduction and maximizing that, the aim is to spread this control over multiple persons. to maximize the business limit. A surefire way of doing this is ensuring that an arm's length relationship is occurring. Even if you're doing business with a corporation that your partner is owning and running, make sure that there are agreements set up, invoices set in place. This confirms the concept that it is an arm's length corporation. In saying all of this, if you're running down that path of you own a corporation and you want to maximize your business limit, and you decide to entrust in your partner to set up a corporation and then control that corporation by owning all the shares, owning all the voting rights, and owning assets and owning a revenue stream, then you better trust that person, because if that person decides to leave you, then theoretically they could take all of that because you've given them that control. And that's, I think, what it's really all about when it comes to control, is who receives the benefits of the operations. If it's making money, who receives the benefits? If it's creating a service and it's, it's not making much money, but it is creating a service, who's receiving the benefit of that service? That's where control could lie under a de facto analysis. When it comes to related persons, who is related? Any blood relationship. This is your grandparents, your kids, your grandkids, your parents, any of your siblings, adopted children, and brothers and sisters-in-law. It also includes corporations. One way I like to think about it is the corporations are like your own children. You've created them and they are in your name. We're going to go back to the scanner where I'll show you one scenario. Right, let's look at the scenario where we're going to have a little bit of a complicated setup. Mr. W right here is going to own 6 corporations. Mr. W has a very solid income stream which he wants to run through 2 corporations. Corporation A and Corporation B. They each have $500,000 each, which he's allocated respectfully. He owns 100% of A and wants the small business limit to go through here, full $500,000. However, B has to be on the hook for fully taxed income. Doesn't like the sound of that. So one idea that Mr. W has is he's going to set up C, D, E, and F. And each one of these corporations is going to own 20% each. Mr. W will own the other 20% each, and he will also own 100% of all these corporations. The idea is that the small business limit will be right here. It'll be all good. And then this group here will be responsible for the other small business limit. Is that going to work? The answer is no, obviously. First of all, it was only set up for the purposes of trying to attempt to get a further small business deduction. All of these entities here are determined to be associated, but then they're also associated with Mr. W, and hence the reason that it all happens to be all associated. There's no way of creating multiple steps really, because they all turn out to be associated in some method. I mean, I've seen a lot of complicated organizational structures, but at the end of the day, someone has to have control of the organizations. I'll give you another minor scenario. Again, Mr. W and Mr. F for Fox. He may have all these corporations out here, and then there's one corporation that is owned 50-50, and they're not at all related, and he also owns his other corporations. What happens to this corporation here? Who has control over it? Obviously, someone has to have control over it. That's the key. Somebody must control this organization. Someone must have put in funds and be deriving some type of benefit from this corporation's existence. So that's really the key there. Sometimes some accountants, what they do is they set up these corporations and they don't list anything under Schedule 23, and it can come back to bite you. The way I see it, and my approach always is a conservative approach when it comes to taxation, and that is to only try and claim what you're allowed to claim. If you are attempting to take a risk and claim further funds, it can result in tax audits and then reassessments of multiple tax years, resulting in a nasty tax liability surprise. So it's something that if you are going to venture down, make sure you do get quality professional advice. All right, that's all for now. Join me for Module 4, which will be coming out next week. We're going to be discussing active business income. This is going to extend to just active business, personal services businesses, and specified investment business income. So I'll see you next week.